Hello and welcome to the Mutual Fund Show on NDTV Profit. I'm Neeraj Shah. We are going to be talking about two key things, and I think the first one is a rarity because while ETF investing is picked up, and we're going to be talking about that with our guest today, leverage ETFs haven't. So we kind of discuss about both these aspects, how to use ETFs to the maximum possible advantage, and why is it that leverage ETFs are not there? Is it only regulatory or are there other reasons too? That is something that we'll pick up with Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC. We'll of course keep Chintan for the full show and get in an advisor as well to try and talk about this plethora of money that is going into thematic funds. As Alex, my colleague, tells me, nearly 50,000 crores of investment money or investor money has gone into thematic NFOs thus far in 2024. Chintan, that's a large number, but I'm going to come to that in the second part of the show. But thank you so much for joining in. You look at passives very, very closely, Chintan, amongst other things. I would love to understand from you, do you think that going ahead, ETF and passive investing will only pick up steam even in an active market like India? Why or why not?
Yes, so having managed active funds, then launching a plethora of passive funds, as you mentioned, and having the entire bouquet, it's been a long journey as such, and I completely agree with you that there is going to be a long road ahead for ETFs in India. And I think the number of discussions across India that I do, more and more queries do come, even in a small, not small, but even in a city like Patna, which I went last week. I did get asked that what is the reason why so many index funds are getting launched and so many people are getting interested in it. I think ETFs, index funds with the kind of smart beta strategies and the sectoral thematic strategies which are being launched, and with more and more family offices also coming into play, I think it's essentially supply creating its own demand. And then, of course, now with India becoming a financialization behemoth, so to say, people are wanting different products, and ETFs and index funds are here to stay. And I think much like how in the West they've grown meaningfully, in India, along with active funds, ETFs and index funds will also grow. And so will all other forms of financial investment.
Chintan, if you were designing a mutual fund portfolio for yourself, let's say, let's assume with an example that the person's age is 30, average risk appetite, average earning capability, and average time horizon, standards, let's say. What's the proportion of passive funds as well as ETFs, for example, that you believe should be there in a portfolio?
I think given the variety of passive funds which are available now, a good combination would be in the range of 75% active and 25% passive. Because in passives, you tend to get a lot of smart beta options, as well as, of course, gold and silver as well. So active 75, passive 25, and within passives today, a lot of scope within sectors, themes, and smart beta. And that list, thankfully, is only increasing in terms of the options which investors have. So I truly believe 75% active and 25% passive would work well for investors to begin with. And of course, under the guidance of their advisors. And going ahead, it can tilt towards 50-50 as well, but that all depends on how the Indian market goes and how the active fund managers are able to perform, plus how well the distributors are able to understand the passive space, because today the understanding of passive space actually is not very strong. So there were few fund houses offering it. Now the number of fund houses offering it is increasing, and there were few distributors or advisors speaking about it. Now that is also increasing. So I think with more knowledge will be more penetration for the passives.
Got it. The problem though, Chintan, is that with the number of funds increasing or number of options increasing, it becomes even more confusing for an average Joe to try and understand what fund should be there. So I'm just trying to think, let's say if you are designing for yourself, what is in that 25% of the passive side, which it may include all kinds of thematics or ETFs, what have you, what would be the top 2 or 3 passive or ETF investments that you would have?
Clearly, the broad market, which is the 500 stock, which you otherwise wouldn't get in an active fund or any other fund. So the 500 stock portfolio which you have is a brilliant passive index fund or ETF to buy for the long term. I think endorsed by the Oracle of Omaha as well. And it's something which you would not get in the active side. Plus, of course, silver as a commodity is something which has a deficit for last 4 years and can potentially add to. So silver may be not a structural long-term bet like the 500 stock universe. So 500 stock universe as ETFs and silver are the two which come on top of the mind. And in the smart beta space, a combination of alpha and momentum, which is the alpha low vol 30, that index is something which I would add to the portfolio. So keeping it simple, the full broad market index, a smart beta product like alpha low vol, which has alpha and low vol. There is a combination of momentum and low vol together, and silver, of course. Gold, I would believe anyways, is a part of investors' portfolio, but if not, then gold and silver ETFs, along with the 500 stock universe and alpha low vol are the four that come on top of my mind right now.
Got it. Okay. Now, the other question that I have in mind is, and something that my producer Anas had a thought for, which is why I wanted to ask this to you. Leverage ETFs, Chintan, are reasonably popular in select markets. In India, maybe due to regulatory reasons as well, they haven't quite taken off. What's the case for such a product in the Indian landscape?
So, globally also, if you look at it, Neeraj, it is about $100 billion industry in the inverse and leverage out of probably $15 to $18 trillion of active funds or active plus passive funds which are managed outside. So it's a very minuscule portion globally, despite it having its own advantages. So I think if you look at it, 2006 was where the first inverse ETF was launched in US. And today there are many products, but it's still a very small proportion. $100 billion is less than probably 0.1% of the global assets which are in long equity. So globally, I think pension fund managers or investors and distributors and allocators believe in diversifying risks through different mediums, but not playing the short side, because playing the short side has been probably a little bit more risky for most times in the last 15 years. Whenever you've gone short, you may have gone right 3-4 times, but you got slaughtered the other time. So hence probably inverse is not picked up globally as well. It's just less than $100 billion of AUM essentially. In India, of course, there is a talk of, there is possibility of a launch of inverse ETFs with the discussion papers which have been recently launched. And I think that would be something which can add value towards the investors who want to diversify their existing long portfolio by having something which will allow them on the short side as well. It's something which is so nascent in the globe as well. So in India also, we will eventually take baby steps once the regulator comes out with the right guidelines, and if the consultation papers, etc., the feedback that they get. But I don't think there is an immediate requirement which is very big from a India standpoint, but more than welcome if there's a possibility for investors to participate in.
Got it. Okay, so you believe right now the case in India is not that large any which ways. If it were to come in, and let's assume the option was there, Chintan, would you use leverage ETFs, or because it's a risky proposition, you don't use ETFs and mutual funds for the risk that you can do equities or leverage trading yourself?
So, of course, there are two ways to look at it. One is pure simple inverse, wherein there is the 1:1 correlation that if the benchmark index goes up, to that extent, you come down in the inverse. And then there are leveraged, which is 2x and 3x, which obviously or arguably are more riskier, because if the index goes up 2%, you tend to go down 6% and compounded every day. It can actually lead to a significant diversion, and many of the ETFs globally have shown that inverse leveraged ETFs, which are 2x and 3x, can be extremely volatile and probably not the palette of every investor. So I would say the simple inverse ETF to begin with, that one broad market indices, is what we should start with eventually. And then as our investors and our advisors get more savvier in terms of the short side, then maybe the leverage can take place. Otherwise, a simple inverse is something which we should look at in the first place.
Okay. Fair call. Well, so that's about ETFs. Now, the big elephant in the room, you have to admit, and I welcome in on the show Kartik Shah, founder of MMI Investments as well, to discuss along with Chintan the big elephant in the room. Kartik, thanks for joining in on the show as well. I really appreciate you taking the time out and being with us. And viewers, the big elephant in the room is the quantum of money, investor money, that is going into thematics. I'll repeat this today with both our experts, but my learning of the last so many months and years of doing this show is that if you are choosing thematic funds or whether NFO or otherwise, if you're choosing thematic funds, they should be a part of your satellite portfolio, not the core portfolio. And if you're a risk-averse investors, then maybe it shouldn't be a part of your portfolio either. So let's try and talk about the how, the why, and the what ahead for thematic funds, because as Chintan Haria very rightly said, the good part also is that the number of options available in this bucket are only widening, and therefore if somebody is wanting to choose thematic funds, then the quantum of options available are a lot more than what they were, some passive and some active. Kartik, I'll start off with you on this. Thematic funds, you would agree that the quantum of options available now are a lot more than what they were maybe a couple of years ago or 5 years ago.
So just we'll take you back to 2017. That is when actually SEBI just changed the whole mandate. So AMCs were supposed to get only one fund per category, except for FOFs, index funds, and thematic and sector funds. So because the AMCs had the mandate to launch as many NFOs as they can, so we are seeing a plethora of NFOs post 2017, 2018. Last I have seen the count is around 170 odd funds, and just August 24 figures, net inflow equities around 38,000 crores, 18,000 crores are thematic and sector funds. So this is because of the mandate of SEBI. Also, for the viewers, if you are a thematic or a sector fund, then 80% of the money is supposed to be invested in that particular sector or the theme. Sector fund by name itself is a narrower version. You can only invest, let's say, in a IT sector or a banking sector. Theme is more broad-based, and in theme, let's say if you have an infrastructure theme, you can have metals, you can have commodities, you can have oil and gas, you can also have banks, because banks are also seen as a part of the infrastructure. These is, as you rightly said, it should be a part of the satellite portfolio. The core portfolio still should be of the flexi caps and the multi caps and the mid caps and the small caps and the index funds. Someone who can time the entry and the exit. Sector funds are for those people. Thematic funds, yes, it's bit for the long term. If you can identify a theme, certain themes, the future holds bright. For example, the manufacturing theme, the investors can have a look at that.
Okay. Chintan, what are your views here? Because as a house, obviously, I presume you also have come out with some thematic funds, some sectoral funds as well, maybe. I mean, in a lot of cases, I remember Naren coming and saying that right now, healthcare is completely out of favor. So I want to launch a healthcare fund because 3 years out, healthcare will do very well. I don't remember the exact time, but I remember there's something that he had spoken to me some time back as well. So you guys are big on taking these calls on the timing of the market as well and launching some of those funds. But what's your view with regards to sectoral funds or thematic funds?
Yeah, so time has flown. So obviously the fund which you're speaking of is more than 5 years old, the pharma, healthcare and diagnostics. So you can imagine how fast that time has flown. And yes, but from an investor standpoint, they deserve all the choices. And as was being spoken, themes do provide a broader canvas within the thematic framework for the fund manager to provide the investor the chance to participate. So if you look at the infrastructure theme, which from 2008 was a forgotten theme till 2021, if investors did invest in that theme, they did make a lot of money across the infrastructure theme. So also in pharma, which is, I think, in India, an evergreen theme as such. So our endeavor has always been to provide investors, the first choice in the sense, starting from Balanced Advantage Fund, which we still believe should be the core, right? So you mentioned about thematics being satellite and even mid and small cap to an extent being part of that. Let's say the satellite or the non-core, so to say, because you can come in and out of that. But the core should be Balanced Advantage Fund, multi-asset fund. That's always been our thought. But in India, luckily, with so many sectors doing so well and so many themes doing so well, with government focus or otherwise our own entrepreneurial skills, be it technology outsourcing, if you see global capability centers, which were not spoken of 5 years back, today it's a $64 billion industry, likely to go to $100 billion in 2030. So India does have the ability to bring out the best in terms of sectors. And if we are able to bring out those sectors from an investability standpoint for investors, that's, I think, a win-win situation for us as manufacturers and for investors and distributors. So yes, I do believe there's a space for India in themes. And because the cyclical nature, if you actually can get the themes right, you have alpha to be created there. And that's where we also have fund of funds, which actually invest in these themes. So if investors don't want to choose that, we'll do the choosing for them in terms of our own thought process in those thematic fund of funds.
Kartik, with the options, and Chintan, thanks for laying it out. Yes, it probably was 5 years ago, just that time really flies, you're right. Now, Kartik, comment on this, with the market looking up fairly polarized, right? In sense, some themes and some sectors are really trading at astronomical valuations, and some, you can argue, are lagging those. They're not really lagging. The market's large because valuations in India are expensive. But because there is such a polarization, could we see more and more thematic funds as somebody who wants to invest in banking, and even if it's a third of the weightage, does not get so many banking stocks if the fund manager believes that the banks are cheap, then therefore the fund manager will have to launch a banking thematic fund or a banking sectoral fund, which I think some fund houses are doing. So we'll probably see more and more of sectoral or / thematic funds coming out. What should people be careful about, or what should people think about when they are investing into some of these?
So first of all, I think investors need to be wary of the fact that are they chasing trends? So let's say IT did well from 17 to 21, but didn't do well thereafter. Last year was PSU, infrastructure, engineering. So are we chasing trends? That is the first thing. Are we chasing trends, or are we seeing a vision, for example, in a particular thing, and that's why we are taking that? Secondly, when you are buying a fund, you also need to see whether there is an overlap within your existing portfolio with a flexi cap or a multi cap fund. If there is a subsequent substantial portfolio overlap of over 50%, that doesn't make sense to take that.
That is by seeing the underlying of the funds.
Yeah. And the thirdly, Neeraj, the most important point is the drawdown. Now, how much people have the stomach to digest the drawdown? If you see with the broader market in the last 10 years, the broader market would have taken a maximum drawdown of 38%. But these sectors have taken drawdowns of 45, 47, 49%. So investors who have the stomach to digest these drawdowns should go for these themes. Otherwise, diversified equity funds give them a proper universe. And it is the fund manager. In fact, if the particular theme or a sector is going to do well, nothing stops the fund manager of a diversified fund to go for these themes.
Yeah, well, because I think the point about drawdowns is important, right? Because the index will probably give you maybe 15, 20% drawdown. Broader markets, maybe 25, 30% drawdown, and thematic funds could actually be much larger. By the way, thematic funds could also give you lesser drawdown too if you've researched it. And I think that is where I think the point from both our experts came in, that if you can time in sometimes the entry, then a well-run thematic fund or a well-run sectoral fund could actually do well, but it should probably be a part of your satellite portfolio. Chintan, before we let you go, from your fund house, what are the latest products on the thematic side that have come out where you believe that the market is not quite constructive, and therefore, even if people are ahead of time and SIP into that, could yield better results? I mean, because you guys typically do that when the theme or the sector is not in favor. It's difficult to figure out what is not in favor currently, maybe except for banks, just looking at the markets the way they are.
You actually answered the question partly. So of course, like I mentioned, we not only bring out the products, we also bring out solutions which actually showcase our view without we having to tell our investors at all points of time. And that's where the entire fund of funds suite which we have is actually to bring out what are our exact views on at different points of time, because investors can actually look at those products. So whatever, if you look at from a thematic fund of funds, since you asked, we've been basically heavier on the pharma side and the IT side in the last 3 to 4 months there. And that has done well, and that can change as well. The thing about thematics, and in an ever-changing world which is changing so fast, and it can change fast in a week's time also, depending on what course of action the US Fed takes. We do believe that investors should look at our fund of funds suite specifically, which are actually showcasing that. So let's say the asset allocator fund of fund would showcase what equity levels investors should have. Thematic fund of fund would showcase what are the themes and sectors we like, and what are the percentages that an investor should allocate to, and so on and so forth. So I'd stick to that investors can look at our fund of funds suite for getting the answer to your question on what do we like right now. But yes, to a very large degree, most of the themes and sectors have performed except probably banking. And to that extent, the larger banks do provide a margin of safety because they are underowned, they've underperformed meaningfully. I think the banking index in the last 1 year is up about 12% versus, let's say, the broader market at 28%, and some of the sectors above 50%, right, like oil and gas and power, etc. So banking does provide a good opportunity from that perspective because they've gone through a big underperformance.
Got it. Okay. Chintan, lovely having you as always. Thanks so much for taking the time out and being with us. See you in the studio sometime.
So thank you. Thanks.
All right. That's the view from Chintan Haria. Now, Kartik, the debate around thematic funds could go on. Let's assume somebody is convinced that she wants to take a little bit of a risk and wants to go into thematic funds. It's a difficult call, I know. But are there some thematic funds that you believe people can look at currently?
So, as you said, the thematic fund is a bit broad-based than a sector. So,
or a sectoral fund, as the case may be.
Thematic consumption is a theme which I feel would do well, and because it will include companies of all the sectors. So, consumption is a theme. There are many funds in consumption which tend to do well. There is one sector which is out of place currently because China's economy is not doing well, but that is commodities. And I feel that China, maybe a year, 2 years down the line, when it again starts doing well, commodity as a cycle would do well. So maybe a staggered investment by SIPs into a commodity fund would also help.
But that's for a high-risk investor.
That is for a high-risk investor. So
somebody who can digest no gains or for a long period of time, or no gains at all, because who knows when China will do what it does. Right?
Yeah. So by nature, sector and thematic funds are for.
But this seems to be a stretch of a risk.
Yeah, it is a stretch of a risk. Otherwise, then diversified equity funds and flexi caps and multi caps are there to take care of this. But other than that, consumption as a theme is doing well. Manufacturing as a theme with China plus one, taking a lot of leverage. So I think these two themes, investors can look at many funds. There are many funds which the problem is. The vintage is lesser because most of the funds are recent funds, but these two themes I am bullish on.
Very quickly, there is a defense fund and there is a defense index fund as well. Between the two, if somebody wants to bet on defense?
So the index fund, HDFC index fund, if we are talking about.
The Motilal Oswal has an index fund.
Index fund, the HDFC defense fund I am talking about. I think it has stopped subscriptions because it has got so much money and doesn't have money to, doesn't have opportunities to deploy. So the valuations are too high. So defense, I would recommend to avoid.
Okay, fine.
Because the valuations are too high.
Yeah, fair call. Okay, now the time for queries, Kartik. A lot of so firstly, thank you for giving us these insights. And viewers, I think the summation of his thoughts seem to be that satellite portfolio, not the core portfolio. Flexi cap funds can actually do some bit of that heavy lifting as well. But if you are investing in a thematic fund, please see the underlying to see the quantum of overlap between a normal diversified fund that you might be having versus a thematic fund that you might, or a sectoral fund that you might be wanting to invest in, and be prepared for drawdowns and volatility and no returns. The returns can be high, but the converse could happen as well in a thematic or a sectoral fund, so be mindful of that. Okay, now a couple of queries. The first query is from Shrikant, age 30 years of age, Kartik. Shrikant says, Shrikant is planning a 50,000 rupees per month SIP. Shrikant's goal is to buy a house worth 1.5 crores in 5 to 8 years, seal retirement by 40 to 45 years of age, and secure funds for the daughter's marriage too. What are some of the funds that he can invest in?
So I'll just let us take an 8-year view. So if he continues with his current 50,000 thing, so he would reach around 80 lakhs of corpus, assuming a 12% IRR. I would request him to do a top-up of 10% per year. By that, he would reach a corpus of around 1 CR in 8 years. Now, I would be assuming that he would be taking a home loan somewhere in the 8th year. So maybe he would be paying 20% of that. So that is 1.5 CR, so 30 lakhs. For that, still he will be having a corpus of 70 lakhs, which would be continuing with an increased allocation in SIP. So that would do him well for his retirement and his funds for the daughter's marriage. What are the funds he should invest in? Well, mix of index funds, a Nifty 50 or a Nifty 100 fund, 2 flexi cap.
Any house is fine.
Yeah, in index funds it doesn't
Any
really matter. Yeah, just the tracking error thing is there. In flexi cap, Parag Parikh flexi cap is a good one. HDFC flexi cap he can take. In mid cap, Nippon India Growth, Kotak Emerging Equities, and small cap, HSBC small cap, Nippon small cap. And for some geographical diversification, a SIP into a NASDAQ 100 or an S&P 500. Now he needs to check with these AMCs because of RBI restrictions on the dollar remittances. Many AMCs have stopped taking investments, but I think Motilal Oswal, S&P 500, Motilal Oswal, NASDAQ 100 is still open for SIP subscriptions. So this would do well. 20% he needs to pay for the home down payment, and yeah.
Okay. Well, Shrikant, I hope you got the answer. It was well defined, really. A bit of personal finance angle thrown in as well on the mutual fund show. Okay, thanks for that, Kartik. The other question is coming in from Chandan Pandey. Chandan is 28 years of age. Chandan says, I want to invest 15,000 rupees per month in a mutual fund through an SIP for a period of 15 years. Again, suggest some schemes to go with.
So again, most of your investors seem to be very well versed because everyone is here for the long term. So that is a good thing to see. Now, if he continues with 15,000 SIP for around 15 years, again assuming a IRR of 12%, the corpus would be around 75 lakhs. So it's a good thing. Now again, the schemes which I suggested for Shrikant would do well for Chandan. Chandan, because maybe he doesn't have anything in between, no house to take, at least not he has mentioned here. So then maybe he can increase his allocation to bit more of mid cap and bit more of small cap. That is it. Otherwise the funds remain the same, what I told for Shrikant.
Okay, so the fund names remain the same, Chandan. You can hear the previous answer. He's given examples Kartik has. You can increase the allocation to mid caps and small caps for a higher beta because you do not have a particular goal, time-bound goal in mind. I think that is the rationale that Kartik Shah is giving as well. Kartik, just one quick question. I remember you having said in the past that in no mutual fund portfolio, the number of funds should be more than 7, 8 or 10 or thereabouts. Is that the holy grail still?
Yes.
So how many funds should be there in a portfolio?
7 to 10 is good enough.
Is maximum?
Yes.
You would rather not have 20 or 30 funds?
No, because it's too difficult to track and too much of overlap.
Okay.
And
so if
many times you water the weeds and pluck the flowers.
Got it. So at times, if people have 25 or 30 funds, they should actively look to reduce some of the holdings and swap into other schemes.
Yes.
Okay, great. Kartik, such a pleasure talking to you. Thanks so much for such pointed answers. Really appreciate your time.
Thank you, Neeraj. Thank you.
Viewers, thanks for tuning into yet another episode of the Mutual Fund Show. Hope you found it useful.